Hey, what's up everyone? Bill Lethman here for Money Evolution. In today's video, I'm going to be talking specifically about some of the money that you might have saved up for your retirement in traditional retirement accounts. So this is something we've talked about in some of our other videos, and what I'm going to talk about specifically today is why some of this money in traditional accounts might become a huge tax liability for you down the road in your retirement. But real quick, before I get into today's video, if you're watching this and you're thinking to yourself, hey, this kind of makes sense, and you'd like to have us help you put together some of your plans for retirement, there should be a link right below this video, or you can go to wealthvisionplan.com. It'll take you over to a website that has some information about our Wealth Vision comprehensive retirement plan. And if you like what you see on that page, there should be a link there to click a button, schedule some time to talk with me one-on-one, and see if our financial plan is something that might be right for you. Okay, so why are we talking about this? Well, again, we're talking about money that you might have in traditional retirement accounts. And just to refresh, if you've watched some of my other videos, you know I've talked oftentimes about the three primary tax types. Traditional tends to be the area where we see people having the bulk of their retirement savings, but you might also have some money in non-retirement accounts. That's something that actually we're going to talk about in a future video, probably come out in the next couple of days or so. We're going to record that right after this. But money that's in non-retirement accounts, and you know you have money there if you get that 1099 every year at tax time. You have to pay taxes every year. And then you might also have some money in the Roth bucket. And so if we're thinking about this, this is money that is taxed later. And then this is money that is basically tax-free in retirement. So you pay taxes before the money went into the Roth, but you pull it out tax-free. With the traditional, you got the tax advantage up front. You didn't have to pay taxes on that money when it went in, but you're going to have to pay taxes when it comes out. So this specifically is where we want to focus for today's video. And let's think about this a little bit. And why is this a potential issue? Well, let's just take an example here. Let's say that you have $1 million in a traditional retirement account, which if you're getting close to retirement wouldn't probably be that uncommon at all. And let's say we're maybe 10 years away from retirement. Let's say we're 55 years old, we want to retire at age 60. Well, if we just use some simple math, we can kind of put some calculations to how this money is going to grow over those that 10-year time period. We use something called the rule of 72 a lot of times here, and what that is, basically, it's a very simple rule of thumb that says if we divide an interest rate that we're earning or an interest rate that we expect to earn into the number 72, it'll tell us approximately how many years it'll take for something to double. So if we're getting a 7% rate of return, the simple math on that is that that money is going to double in about a 10-year time period. So 10 years from now, at age 65, let's say, you would have potentially $2 million in that account. And then depending on how you started taking withdrawals on that account, again, at 70 and a half, which is one of the big issues that we have with this money that's in traditional accounts, you're going to have to start taking what are known as required minimum distributions, or RMDs. And that number starts off, it's actually a divisor that you're going to divide into the previous year's 401k or IRA balance, and that's going to tell you how much money you need to take out. But it starts off at, somewhere a little bit under 4% per year. But at 4% of $2 million, and again, we're not even counting on that next 5 years worth of growth, that could easily be $80,000 of withdrawals that you have to take out no matter what, otherwise you're going to get penalized by the IRS. So as you're starting to put together some of your plans for retirement, one of the things we talk about a lot is having a tax plan for your retirement. In fact, it's actually one of our 7 core elements of retirement planning that we address in that financial planning process here. But looking at what that future tax liability is going to be very, very important. So a couple things that we want to talk about today. One is the Tax Cuts and Jobs Act. Okay, so I think that this is something that presents an opportunity for a lot of us, and this is something that was passed in 2018, was the first year that we had where those tax rates came down a little bit. So pretty much across the board, I think you'll find that these tax rates are a little bit lower from 2018 until they expire in 2025. So a couple things you can think about, especially if you have these 3 tax buckets, maybe a little bit lopsided. One thing is you can, if you're still contributing, maybe, especially if you have that as an option here, is look at maybe contributing to that Roth 401k plan if you have that through work. If you qualify for making a Roth IRA contribution, you could do that instead of making those traditional accounts. So you can try to balance these buckets out a little bit more. If you're looking to do something a little bit more aggressive, you could look at doing Roth conversions. And so a lot of times what we'll do there is we'll see, where are you at within that income tax bracket? How much additional money could you basically earn or take out of one of those retirement accounts until you hit that next highest tax bracket? Use that as a Roth conversion, pay some of that tax right now, and then you can get that at a lower, you can get that tax-free down the road, but you're going to basically be taking that money out at a lower tax rate today versus what those tax rates might be in 2025. So quick example of this, you might find yourself, maybe you're in the 22% tax bracket today. If the tax rates revert back, or when they revert back to what it was previous to that Tax Cuts and Jobs Act, that might be the 28% tax bracket for you. And so that's a huge savings. If you're looking at saving 6 percentage points of tax, that could be a very, very big deal for you there. So you want to look at that, the Tax Cuts and Jobs Act. And then also too, as you get into retirement, one of the big things that a lot of people kind of get blindsided by is Medicare premiums. So not only will those RMDs possibly force you into a higher tax bracket, but it also could make your Medicare premiums go up too, because if you didn't know already, your Medicare premiums are going to be tied to your tax rate. Whatever tax bracket you're in, that's going to dictate those Medicare premiums. So again, I think one of the most important things that you can do as you're starting to put together some of your plans for retirement is to kind of think about this a little bit and create that tax plan. That's something that we do all the time through our financial planning process. And the earlier, quite honestly, that you begin this, the more options that you have. So if you think about this, if you've let that account grow from $1 million to $2 million and you're 65 and you're starting to implement some of these strategies, you're not going to have as much opportunity than if you started doing it back here when you were 55 and maybe started contributing to that Roth account instead of the traditional account, and maybe that grew at a little bit slower amount, but you built up some extra money in the Roth bucket. So anyway, kind of a quick video here. I hope you got some great information out of it. And again, if you're watching this video and you're thinking, hey, this kind of makes sense, I kind of want to get some of this planning for my retirement, look at some of these tax strategies in a little bit more detail, we have what we call the Wealth Vision Comprehensive Financial Plan. Again, if you go to that wealthvisionplan.com or click on one of the links below, it'll take you over to that website. It'll have a little bit more information about it. And again, if you like what you see there, there'll be an opportunity for you to set up a one-on-one consultation with me, see if it's something that might be right for you. So anyway, with that, have a great day, and I'll see you back in one of our next videos. Thanks.